Breaking news out of Wall Street, and if you're an iPhone user watching your wallet, you're going to want to hear this right now. JPMorgan, one of the most influential financial institutions on the planet, is throwing a curveball into the ongoing Apple tariff conversation, and it could mean the difference between hundreds of dollars staying in your pocket or flying straight into Apple's coffers. Here's what we know. Concerns have been swirling for weeks, months, really, that Apple would be forced to dramatically raise iPhone prices in the United States as a direct consequence of the sweeping tariffs imposed on Chinese manufacturing. And given that the vast majority of iPhones are still assembled in China, those fears were not unfounded. Analysts, consumers, tech journalists, everyone was bracing for impact. We were talking potential price hikes of anywhere from $100 to even $500 on certain models. That's not pocket change. That is serious money for everyday Americans already feeling the squeeze of inflation. But JPMorgan is now pumping the brakes on that apocalyptic pricing scenario, and their reasoning is actually quite compelling. According to JPMorgan's analysis, the actual price increases that Apple passes on to consumers may come in significantly lower than those worst-case estimates that have been dominating headlines. Why? Because Apple is not simply sitting back and absorbing this crisis passively. The company has been aggressively diversifying its supply chain, accelerating manufacturing shifts to countries like India and Vietnam, and leveraging its extraordinary purchasing power and supplier relationships to cushion the blow before it ever reaches the retail price tag. Think about what that means in real terms. If the broader market was pricing in, say, a $200 to $300 increase on a flagship iPhone 17 Pro, JPMorgan's revised outlook suggests Apple may find ways to limit that increase to something far more palatable, potentially keeping hikes modest enough that the average consumer doesn't completely abandon an upgrade cycle. And that distinction matters enormously, not just for you as a consumer, but for Apple as a business. Because here's the brutal economic reality: Apple cannot afford a mass consumer revolt. The iPhone is still the engine that drives the entire Apple ecosystem. Services, wearables, accessories, they all flow downstream from iPhone adoption. If sticker shock kills upgrade momentum, the ripple effects hit every single line of Apple's balance sheet. JPMorgan clearly understands this, and their note signals confidence that Apple's leadership, Tim Cook and his team, have been doing the behind-the-scenes work to protect both margins and market share simultaneously. That is an extraordinarily difficult tightrope to walk, and not every company could pull it off. But Apple is not every company. Now, let's be crystal clear about something: this does not mean prices are staying flat. There will almost certainly be some price increases when the next iPhone lineup lands. Nobody is suggesting Apple absorbs all of these tariff costs entirely. That would be financially reckless. But the narrative is shifting from catastrophic to manageable, and in today's volatile economic environment, manageable is actually a very big deal. Apple shares trading on NASDAQ under the ticker Apple have been under significant pressure throughout this entire tariff saga, and news like this from a heavyweight like JPMorgan has the potential to restore some investor confidence in the stock's near-term trajectory. The bottom line? Wall Street's smartest money is now betting that Apple finds a way, as it almost always does, to navigate through the storm with its premium brand positioning and its loyal customer base largely intact. But here's the question that should keep every Apple executive and every iPhone competitor up at night: in a world where even a modest price increase could push cost-conscious consumers to finally consider alternatives, how long can Apple keep defying economic gravity?